Alright, I was debating whether or not to make this video, but I just can't ignore it for a number of reasons, mainly being logical inaccuracies. Today I'll be reacting to a video called Palantir Stock is Just Hype by Everything Money. I'm going to cut clips from their video and share my counterpoints. But first, please let me make this clear. This is not an attack of any kind against these gentlemen. Unlike the opening in their video, in which they call out other specific YouTubers, I will keep this video professional and not call anyone names. Instead, I'll be breaking down their reasoning so we can see if the video holds any real value, or if it's just more noise from a few bears. Let's go.
Good investing is about long term. We all revere Warren Buffett. We all quote Warren Buffett. But who actually does what Warren Buffett says? He never looks at day-to-day or month-to-month stock prices. He looks at long-term stock prices.
Good investing is about the long term. I completely agree with this, and I do agree with some points that these gentlemen bring up, especially about the long-term nature of investing. So this guy said not to stress the day-to-day or month-to-month stock price movement as a long-term investor. We'll see if they complain about Palantir stock getting cut in half later in the video.
I always say that everybody else on YouTube, except for a few value investors, do not get it. They sit there and talk about hype and only hype. They cannot explain to you why stock goes up or stock goes down. They just make up a bunch of baloney, or they say a bunch of things that sound cute, and it works for them.
That's a good point, actually. You saw a lot of videos come on when Pltr was consistently hitting all-time highs earlier this year. But now, who is making a video about a stock that has lost its positive momentum, and who has chosen not to? There's a lot less interest, I can tell you that. But the thing is that you should like the stock more when it goes down, not up, especially if you're planning to increase your initial position size. And, in my eyes, investing in a stock is not a one-time thing, as we'll get to more in this video. It's about routinely, perhaps quarterly, diving deep to evaluate the strengths of a business, to identify the trajectory of the core financials, and make buying and selling decisions based on that. So now they're supposedly going to give us the reason as to why they don't like Pltr. I'll play the clip and be back in a minute.
I can love the founder, I can love the software, I can love the company, but I don't like the stock. And we're going to explain to you why fundamentally that's the case.
We use an 8-pillar analysis looking at the fundamentals, the math behind the company, what they're making, the shares they're doing. We're going to do it right now for you in this video, and you'll see what other YouTubers are frankly not pointing out.
Right now, the company is a $33 billion company on market cap. That's the number of shares times their stock price. 33 billion. Their revenue is $1 billion. That's 32 times revenue.
Is that good or bad?
That is awful, guys. If you go look at other software businesses, things like, let's look at Microsoft on our software right now. Microsoft currently sells for 11 times sales. Oracle sells for 5.9 times sales.
Good Lord.
So this is a company that has a lot of growth potential, Palantir. I get that. But at some point, you have to sit there and pick a reasonable price for growth. That is not happening here. They have no profit. They lost $1.3 billion. They did $1 billion in revenue and lost $1.3 billion last year. No profit, great gross margin, but no profit whatsoever, pays no dividends, etc.
Okay, a few things. If you're going to do this sort of attack against the stock, you better be using the most recent financials, which they haven't done here, which is not only misleading, it also reduces their credibility in my opinion. The video came out after the Q1 earnings report, yet they did not choose to use the updated numbers. Instead, they're using Q4 2020. That's concern number one. So those updated figures are $1.205 billion in trailing 12-month revenue, which translates to a trailing 12-month revenue multiple of about 29.3 times, and that's 9% lower than the number they were showing. So there is quarterly improvement happening. Of course, the stock going down also helps that multiple, which takes me to the comparison with Microsoft and Oracle in search for a proper multiple and thus valuation. Palantir on the conference call addressed a question which was about it competing with Microsoft, and I'll tell you why this is important. Palantir said they're actually completely different from Microsoft in the sense that Palantir is competing against their clients, be that commercial or government, desires to build their own solutions. They're not competing with other software companies like what traditionally happens in the sector. Palantir is so embedded into the US government and will eventually have a monopoly with Palantir Gotham in my eyes. The growth is just insane, and that's not even to mention the commercial side. So this takes us to the question of what multiple the stock should get. Should Palantir, growing much faster than Microsoft and with incredibly sticky clients and customers, get the same profit to sales ratio? Of course not. They're completely different companies in completely different life stages. I don't believe there's an accurate comp in the industry because Palantir does what no one has before in the market with its platforms, assessing both commercial and clandestine needs. Their products have the singular goal of alpha generation for their customers. They're deploying the vaccine with the US and UK governments, leading the most successful operations and helping businesses save millions on operations all around the world. There's no comparison here. Now they're going to break down the income statement, again using outdated numbers. But listen to what they say about the good and the bad.
What we like to do is look at the income statement. Now, their revenue growth is very impressive. This is by half year. This is by quarters. It's a weird thing. Bottom line is 322 million in the last quarter of last year versus 229 in the previous quarter of the previous year. So good revenue growth there. Look at this profit, guys. They just lose money like crazy. Just lose money like crazy. Shares outstanding.
Why is this important, Paul? The
this
shares
is important.
outstanding.
They've doubled their shares outstanding. This is one of the most important things that people ignore. We never talk about this. The pie is being split up more and more every single time they issue more shares. So your share of the profit and revenue decreases every time they increase their shares to finance the business. Nobody ever pays attention to this. This is the slow killer for stocks. It is going to kill your equity in a business. Nobody talks about that. I bet you if I interviewed the 3 top YouTube finance people about shares outstanding, they wouldn't even understand what that meant.
So what they're losing money? Most successful businesses do in the beginning. I heard over and over and over again on the conference call that Palantir is investing heavily in their business, in product development and R&D. I don't know about you, but that's exactly, and I mean exactly what I want to hear as an investor. Undertaking short-term expenses for long-term profits once maturity and scale happen over time. And the thing about outstanding shares, of course I know what outstanding share count is. That's a fundamental concept. And I've been talking about PLTR, stock-based compensation, for months now. So I'm not going to get into it all again. But I appreciate that employees and management have strong alignment with shareholders, as COO Sankar was mentioning on the conference call. And I also realize that this enables the company to attract and retain top talent, which is absolutely critical to Palantir's mission of helping companies and governments solve the world's hardest problems. I do not view stock-based compensation as a deal breaker to keep me out of the stock, but I do understand some people's frustration with it. And then they go on to sell you on access to their work and their investing, which they push 3 separate times, saying to subscribe for their Patreon page, something I will never do. You get access to my content for free. Take it or leave it. Let's continue.
2.26 billion in current assets, which is basically the cash on hand, versus $600 million in current liabilities, which is phenomenal. In fact, they only have 1.2 billion in total liabilities. So from a balance sheet perspective, that's awesome. It's a phenomenal balance sheet company, which is typically the case amongst against new software businesses. I like to look at free cash flow because free cash flow is cash from operations less your capital expenditures. It's how a company pays for dividends, buys back shares, makes acquisitions, and pays down debt. That is more important than earnings because earnings can be manipulated through a myriad of methods. Cash flow can too, but it's much, much harder to do so. Let's look at the cash flow. We add this part to the free cash flow, to the cash flow statement. Loss of 163, gain of 332, loss of 53, loss of 23. It's getting better. The average company will sell for 15 times free cash flow.
Yep.
Market cap is 33 billion. Divided by 15, you want to see $2.2 billion in free cash flow. You're seeing a loss of 23 million. Does this company have a lot of growth potential? Absolutely. But to just be worth what it's selling for today, assuming they issue no more shares, you got to generate $2.2 billion in free cash flow.
I've got to give it to them. They acknowledge the growth potential, but Palantir is just not an average company. That's the thing. And maybe you don't want to buy them because of that. But again, with the multiples, we got updated numbers from Palantir in the Q1 earnings report. And on the conference call, they even pointed to their adjusted free cash flow as the indicator for the business's ability to generate cash. So yes, that's an adjusted number. But look at that radical improvement year over year. The business is improving. I just feel like they're cherry picking certain statistics and points points of view, which makes it seem like a short-term focus. Sure, if you don't like the company in the short term, go short it or buy puts, but I'm not buying shares for the short term or calls for the short term. I'm buying and holding shares for the long term, and I know many of you are doing the same.
You invest in what's probable, you will do very, very well. Remember guys, it's not about getting the 10, 20, 30 times your money. It's about finding the singles and doubles, the 20, 30, 40% companies on a year-to-year basis. You're gonna have some dogs. This is what it's about. It's also about avoiding major losses. The more expensive the company, the more likely for losses. If you don't understand that concept, you need to take a step back and realize that the more you pay for something, the less, that is what risk is. The more you pay for it, the less likely it is to work out for you.
So then he goes on this tangent about choosing companies that will deliver 20% growth, hopping in and out of stocks year to year. That is completely not what I am trying to do. I want to pick the long-term winners. I've said on this channel before that Palantir might be a 15-year play for the long run. I completely understand how most people, if not 99% of investors, do not want to focus for that long of a time period. But to me, choosing businesses that seem cheap, they're cheap for a reason, and hopping in just to get a 20% or so gain year after year, you're introducing so much complexity. So this is not what this video is about, because I'm not even entirely sure what their trading strategy is or what they're pushing. But to circle back to Palantir, if you don't understand the potential of the company, of the platforms they have, and don't think they can be a 10-bagger in the medium term and much more in the long term, starting from today with a couple hundred commercial clients and hitting their target of 6,000 commercial clients and scaling across governments, eventually hitting mainstream with medium and smaller size businesses. If you don't see that as an eventual reality, then stay away from the stock. It's that simple.
Warren Buffett and Charlie Munger are 92 and 97, and in their annual meeting last week, they said this is the most extreme market they've seen in their entire lives. They lived through the Great Depression, and this is the most extreme market they've ever seen in their entire lives. That should be an indication for you guys what is expected in the future.
Why 2 months ago were there just as many YouTube channels as you could find based on quote unquote investing are telling us the price is going up? We're just flocking to this price. We should just
they saw this happen. So this is what happens, guys. When stocks go like this, they assume it's going to go like this.
Surprise.
Now it's in half. This was 39. This is 18.
The stock got cut in half. That was not something I saw coming, but it's an incredible opportunity. Again, if you don't like the company, stay away from it. No one is forcing you to buy, but if you do believe in it long term and the valuation was a concern to you, that valuation is also cut in half. Those multiples used to be so much higher and the financials are improving. Frankly, I think it's a lot harder to justify Palantir dropping from here after it's already got cut by so much. But again, I don't care what happens in the short term.
Let's just go back to when everything started on this downturn. Right here. You saw your stochastic turn on you and it went to a negative trend. It's been that way ever since. That was end of January. You would have known if you were trading with me that you would have gotten this downtrend going, engulfing candlesticks, and this downward trajectory. And I mean, looking back, it's easier in retrospect, of course, but this is all you need to know. This reversal in trend, you would have exited the position or you would have shorted it. It's as simple as that. Mm-hmm. If we have a reverse trend like this, you're not going long in any position. So you would have been out of this. You were in that downtrend. All this was, this little rebound right here, that was called a snapback. You were still in a downtrend, but the price was snapping back on you. So right now, this thing just keeps falling. We're at a support level right now, but man, if you get more engulfing candlesticks going like this, especially with this negativity that it's having in the news and the markets right now, I mean, today it's up 8%. I mean, something happened with earnings, but keep watching it. But man, this might be a good one to short.
Something happened with earnings apparently. Yeah, they killed it. There were negatives. I went over those in my earnings recap videos, but they did a great job overall. This guy said, if you were trading with me, you would have sold. I would have told you to sell. That's the thing. I'm not trading. I'm investing. You may be different. You may have different objectives. If you want to trade stocks and you also want to pay for access to a community, to unprofessional advisors to tell you what to do, then by all means go check out their channel. So again, I'm not trying to attack these gentlemen. I'm just trying to push back on some of their comments here. And as I said, I do agree with their long-term fundamentals. I just don't agree with what they're saying about this business, or frankly, this stock. So let me know in the comments below, who are you siding with? And try and acknowledge your biases. I definitely will. I'm a shareholder. But anyways, I hope this video was insightful and at least gave you a little bit of a back and forth. Hit like if you appreciated it. Until next time.